Welcome to the Q1 2025 update for the Vanguard Global Credit Bond Fund. Thanks to our bottom-up security selection process, the fund has been able to generate over 11% alpha cumulative since inception. Joining me today is Sarang Kulkarni, Lead Portfolio Manager.
Good morning.
So Sarang, it's been a volatile time for markets. A lot has happened, and markets have primarily been focusing on US policy. So in your opinion, what is the likely impact of tariffs on corporate fundamentals and therefore credit spreads?
A lot of it will depend on where tariffs and even some of the non-tariff barriers ultimately end up. But for us, the biggest focus is on supply chains and what it means for the end markets for goods. And at the end of the day, companies can adapt. They have the ability to, source products from other areas. They have the ability to probably look for new markets. But that transition is always difficult. That transition always costs more money. That transition always brings about its uncertainty. So for us, it's still wait and see. There are definitely some sectors where the tariffs are definitely front and center, like steel, metal mining, automobiles, where I think the market has also started to reflect spreads, pushing them wider. They are sort of underperforming the broader market in that context. But we will probably see this impact, move out to other sectors. So from our perspective, I think the best thing to do is try to look for opportunities where you're not that impacted by sectors. And so, for example, you can find a lot of industries where, as a reason, or maybe just by the nature of the business, you are kind of more moving, or you are forced to have more localized production. So cement is obviously one of them. It doesn't travel very easily, so very localized production. Beer, also not a lot of import and export in terms of actually the finished product. So you have a lot of localized production. Industrialized gases, where a lot of gases get produced on site, whether it's for hospitals or factories. And even things like financials. Financials, again, are quite localized. So from that perspective, we can still find good opportunities that are not that impacted by tariff from a fundamental perspective.
Very interesting. And thinking more now about the quality spectrum, what is your view on investment grade versus high yield and the outlook for that going forwards?
I think this environment is going to be very, very interesting for high yield. There are obviously some good opportunities. We have actually seen a repricing. And so you will see some better valuations come in. But what does spring to mind for me is the fact that if you look at last year, a majority of the defaults that you saw in high yield was sort of distressed exchanges. So it's not that companies couldn't pay, it's they chose not to pay, and they find restructure their liabilities. And we're going to go into an environment where tariffs are sort of upending the fundamentals. Market volatility is high, and there's a lot of dry powder sitting in the form of private credit and other sources of capital for the sector. So I do think the incentive for management teams to actually look at more distressed exchanges or restructuring has gone higher. And as a result of it, you might actually see more of that activity come through.
Okay, well, that's interesting to know. And then finally, thinking about the fund itself, there has been a lot of volatility, as we mentioned. So in light of this heightened volatility, have you had to maybe change your approach to portfolio management in the fund at all?
Well, one of the things we do, as you know, is we don't try to make, big outright calls on what the direction of the market is, or even in terms of, what's happening with interest rates and central banks, because these things are actually hard to time. And market timing is, it's a valuable way of adding, alpha, but it's not one that we think we as a firm or anybody has that kind of special edge. So we haven't really changed what we're doing. We're still focusing on our fundamental research. As we talked about, we're looking at initially sectors where, you do see very limited impact from tariffs, so that are not exposed to tariffs that much. As we get more clarity on tariffs, we will be looking at companies that can adapt very quickly, and where possibly you see the new kind of state of fundamentals priced into spreads, or even you're overcompensated for that. So I don't see a limitation on sort of bottom-up opportunities going forward. So I don't think we've got to really change our style in order to continue to generate alpha. I do think that the uncertainty around tariffs will make, the environment a lot more volatile. But for us, I think it really means you got to dig into those long-term, value opportunities, where the fundamentals and valuations are, in our opinion, like you're really being compensated for the risks that are out there, and try to sort of earn our performance from there.
Well, thank you very much for joining us, and thank you all for listening, and see you next quarter.